All right. Welcome to YWR. It's Payroll Fridays, and we're here with Marvin Barth. Our topic is new Fed Chairman Kevin Warsh, and what does this mean for our bull market we've been enjoying? We have a new leadership at the Federal Reserve. This could change things in several ways, at least two that we're going to discuss today. And I brought on our good friend Marvin Barth, who writes two publications, Seriously Marvin, on Substack, but also he's got a institutional research product, Thematic Markets, one of the best thinkers out there, especially on economics. And I mean, that's his specialty, but also Marvin worked at the Federal Reserve. Very very knowledgeable about how that organization works. I think Marvin, weren't you just, you were at a function with the Federal Reserve, I think last month in DC. So your connections, you're very up to speed with the current, people involved in the Fed, their thinking, and you have a lot of views on this. So we are super lucky to have you here to, chat about this today. Thank you.
Well, thank you for having me on, Eric. It's always a pleasure to be on your program. You always have great topics, great guests, and it's a real honor to be here.
Yeah, I think the last one we did was the rise of the solopreneur, right? And
Yeah.
it was how whether the economic data was the labor market looked maybe weaker than the economy actually was. And I just spit that out as a view, off but you were like, I'm actually going to test that statistically, which you did, and you wrote an amazing paper and went through, five factor. It was a multiple ways of testing whether this was actually the case. And why you are so much smarter than the rest of us, and actually, definitely.
You say that, and you sort of glossed over the part where you mentioned this whole solopreneur thing, and this is what you should really look at.
Well, I was
So,
just, but I know, but it's like there's like just saying things and like proving it at an academic level, which is at a or a professional level, which is why we like to talk to you. So we have a new chairman of the Federal Reserve. Sorry, I'm echoing sometimes, but and I think there's two things to talk about. There's one is, well, maybe we'll park monetary policy for the second thing to discuss, but I wanted to start with another one that's been interesting to me. And one of my themes is my background is looking at financials. Is I've been talking about how banks, I feel like, have been in the doghouse since the financial post GFC. As you remember, you know, big liquidity crisis, financial markets from Europe to the US were rocked, and post GFC regulators was really this can never happen again kind of mentality. And you had regulation changes to capital requirements, liquidity requirements, which were a new thing. That turned into be something the regulators had into. Sorry, maybe you might like this. So
I think
regulators.
actually, I should switch. I'm not using headphones. I think I'm the problem. Sorry. Give me a second.
Marvin? Oh, it's
Yeah.
yours? Okay. So I'll continue
Yeah.
on. So regulators post GFC were really banks were in the doghouse. In the UK, there was even wind down rules. Banks had to come up with plans about how they would go, how you would shut one down. So they were kind of writing their own death plans. And then at the same time, also there was negative interest rates. So banks are having a hard time making money on their spreads. Post COVID, coming out of COVID, we had this situation where banks were finally starting to make a lot larger loan margins, and they were very well capitalized. You had a lot of banks in Europe with 12 to 14% tier one ratios, and you had banks in the US 10 to 12, which always ran a little bit less. And I kind of thought, wow, maybe we're starting to have an inflection point for the financial system. You're starting to have interest rates are rising, banks are making more money on their spreads, and this capital issue has we're done with it. It's kind of put to bed. There's no new rules coming from BIS ratios, and so I thought that's what made me positive on banks in 2022. And as you know, we put that in the dirty dividends. It's like, I think, almost 60% of the fund now, and it's done very well. Um, but another part of that an economic side of this is I was interested in how what happens if the pendulum swings from kind of building capital to lending again, and what happens if the animal spirits come back to the banks, and what does that? I mean, we all talk about, I think this economic growth has got multiple layers. We have government spending a lot of money. Now, kind of the spending 5 to 6% of your having budget deficits in the 5% range is almost not normal, but it's kind of persistently we're having higher deficit spending. Um, we have high CapEx. We've got companies spending their brains out on a brand new revolutionary technology. And then on top of that, I think this layer that is underappreciated by the market is that banks are starting to lend again. I was looking at the H8 data from the Federal Reserve. Um, it's like, I think we're in the 7% loan growth right now, but it's kind of above the 4 to 5 it's generally been. It's not extreme yet, but from here, it would start to be quite notable if you continue up at this level. Um, and this is why this is why I was kind of thought of Marvin, is Kevin Warsh, I think there's a whole change in tone coming from the top that, wait a second, we want to grow the economies. Need to grow the local economy both in Europe. They have the same problem. They wanted to grow we need to stand on our own 2 feet. We need our banks to be part of this process and engaged in growing the economy. And the US is doing the same. And I think, Marvin, I wanted to weigh in here because I think Kevin Warsh is kind of, uh, a part of this whole change in tone around regulations and bank capital, and I mean that banks might be risk on for banks again is what I'm kind of trying to say.
Yeah, I think that this is definitely one of the key things that people should recognize is a change in tone. And it's quite interesting that the tone seems to have changed even before he came in. So if you look at Vice Chair for Regulation Mickey Bowman's most recent speeches, she's talking about how they need to sort of wind back some of the onerous regulation around Basel III, and that certainly there was some overkill in some of those. The former vice chair for supervision, Michael Barr, has also given a speech talking about exactly this sort of issue. So it's almost like for analogy for some people may not remember this, but we always give um, you know Ronald Reagan credit for deregulation and tackling inflation. The reality was that Paul Volcker was appointed by Jimmy Carter, and that whole move started before the Reagan
Mm.
Revolution, so to speak. Same sort of thing happened. There is a shift in the sentiment overall, but I think in the same way that you know, Volcker was this massive shock, even as the broader system was sort of moving in that direction. Kevin Warsh, I think, is very much a different animal to what we've seen. So recall that Kevin Warsh was on the Federal Reserve Board before. He was there in the late 2000s, and he resigned in 2011, and he resigned in protest over quantitative easing. He effectively thought that this was stretching beyond the central bank's mandate, and that they were going to pay a political price for this. I would actually say you go back and look at the transcripts of the 2011 meeting just before he resigned, and all the things he said have become true, right? Like the backlash that we're seeing against the Fed, I think he actually laid that out in 2011 as this is going to happen if you go down this path.
What he said,
Um,
it was post GFC, and he was saying, what you need to kind of be getting out of the economy, right? Or is that what the
yeah,
message was?
well, so he was fully on board. with the Fed doing its lender of last resort functions. Remember, what is a central bank actually there for? What is it created for? We think that it's all about managing interest rates, but a central bank's original purpose and main purpose was a fractional reserve banking system is necessarily unstable, right? You have deposits, which anybody can take out at any moment, being used to fund loans, which have a longer maturity, right? And so that's an unstable relationship. And you could have that a bank is fully solvent, all those loans are good, but everybody just decides to pull their money out because they get scared or they need their money back in a liquidity crisis or something like that. Well, if you have a central bank that can provide you with unlimited funding, and the key thing about that is it's collateralized funding. They say, hey, you pledge your loans to us, we'll give you some funding in return. This is not a bailout. This is actually just a source of liquidity for you in a time of need. That's all it is. He was all for that in 2008 and 2009. What is often called QE1, which I think is a misnomer. It wasn't quantitative easing. It was traditional lender of last resort functioning. The banks couldn't get money from anybody else. They gave collateral to the central bank. The central bank gave them liquidity. That's central banking 101, as I just said. Um, what happened in 2011 is that the Fed decided they were at the zero lower bound for interest rates, and they said, "Hey, we don't know what else to do here, so we're just going to start buying bonds and see if forcing liquidity into the system is going to have an economic effect." Now, I've written about this. Other people have written about this. There's a lot of debate about this. My research is very clear on this. QE was totally ineffective economically. It was totally ineffective in terms of its market effects. It was a complete waste of time. And all it did is create this big, huge target in Washington, which is exactly what Kevin Warsh was saying in 2011. He said, hey, lender last resort, great. But when you start doing this stuff, you are just painting a big target on the Fed for everyone to come after us.
Mm.
Right. And he was, I would say, very prophetic for all these people who want to complain about, Donald Trump's attacks on the Federal Reserve. Where the heck do you think this stuff came from? It came from the fact that everyone was so angry about the Fed being so omnipresent throughout the economy. And that's not to excuse anything that Donald Trump has done or otherwise, but just to say that didn't come from nowhere. And credit to Kevin Warsh, he was early on in saying this, even on the doorstep of this event, to say this is going to cause problems. So the reason why I give you that background is he has always been about slimming down the balance sheet. If you've seen him since 2011, literally every speech this guy gives, every interview he gives, he talks about the need for the Fed to go back to a pre-GFC style balance sheet, which is a lot smaller. And we can go into the details
Can I
about
just
some of
say
that if
another
you want
thing
to. But
awesome?
yeah, please.
But I mean, the fact that he resigned over this, I don't know if he had some other thing he was itching to do, but like I've
No.
never seen that, right? No, they might dissent a little bit or talk on the behind the scenes, have a quibble or do a speech that's a bit on the edge, but he upped and just left the whole Fed over this thing. It's
Yeah.
kind of a
Okay.
big
So
move, right?
yeah, and there's a couple really interesting points to
I mean, what
that,
is this
Eric.
guy? Guy is principled or something, or I don't know.
So I would say he is. So when Elizabeth Warren, who obviously Elizabeth Warren plays a lot of politics, fine, is calling him during his hearings a sock puppet. I'm like, this guy resigned over this stuff before. Really, he's a sock puppet. This is like one of the most principled people we've had at the Fed. Right? And I completely dismiss, and this is going to be a big part of, I think, our conversation. I completely dismiss this idea that he's going to be some sort of puppet of Donald Trump to lower interest rates. In fact, I think, and I've written about this. You've seen what I've written about him. I predicted that he would be picked And I've been saying all along, he was going to be picked because he is a hawk, right?
Mm,
He will be a hawk. And so I think that's one really interesting aspect of it. By the way, there was a sort of politeness to how he did this. So at that 2011, his last meeting, he actually did vote with the chairman. He did not dissent. So
mm.
he gave deference to then Chairman Bernanke. Said, "Look, I'm not going to embarrass you here, but he spoke very clearly at the meeting. I'm against this. I don't think we should be doing this, and we're going to have a lot of problems with this." But then he wasn't a fool, gentlemen, because the second he walked out the door, he wrote a Wall Street Journal op-ed piece slamming the Fed for doing
Yeah.
this.
But I wanna come back a little bit to the banking piece of
Yeah,
this, and just as another thing is, didn't wasn't he like he was, I think, an economics major at Stanford, then went on to get a law degree, but he worked in Morgan Stanley in just investment banking for a
yeah.
long time. And I think that's, um, one of the criticisms or not cr but sometimes it comes up, he's not really an academic economist like many of the Fed governors are. So
Yeah.
I just go back to, this piece that I think it's gonna be in the background, but I just feel I think he's, um, this is gonna be helpful for the message to the banks is, "Look, we're not gonna we're not looking to get you any time you trip up. Look, please be involved, grow, take risks, do what you need to do, support the economy. We don't have any new regulations we're coming up with. In fact, and I think you've done a lot of work on this. It's a little bit complicated, but I think it's like some of the and Marvin, like some of the liquidity ratio, some of the different rules are almost contradictory. How like you have to do this to comply with this rule, but then that
Kind of.
makes you. I don't know. I was trying to read one of your parts
They're a
about it.
complete, absolute mess of contradictions. But
Yeah,
we go. Look,
but he
you're
said, look, we should unwind some of these things, right?
yeah, so this is the critical point. The reason why I wanted to talk, why I mentioned the whole 2011 the QE thing is he's been about the balance sheet the whole time. Now, the critical element of the balance sheet and why the Fed has a hard time reducing it now is because of all these bank regulations that effectively force banks to hold a lot of so-called high quality liquid assets. Among those are treasuries, but the Fed regulators have largely and there's kind of a little bit of a problem here of the left hand not talking to the right hand. So the regulators themselves at the Fed will say, "Hey, we want you to hold lots of these." While the law says that treasuries and reserves are exactly the same in terms of high quality liquid assets, we think you should hold reserves. Meanwhile, the monetary policy people at the Fed are like, well, gosh, we got this problem. We got all these reserves and banks won't stop holding them. Well, that's
Mm.
because the other side of the Fed is telling them. The point here is that bank regulations are absolutely embedded in why the Fed balance sheet is larger. And we can go on to all the issues of the contradictions of the Basel
And I think
III
you're going to
rules
write
and how
something
they
about
create that.
this next week, right? Or you're going
Yeah, well, I'm focused on I'm writing something on Kevin Warsh and what to expect from him now. I've written a fair amount on, why these regulations are completely um, contradictory. They're just crazy, and they definitely do repress bank lending. So I think to your broader thesis, the thing that I would say I wholeheartedly agree with is in the background, what this whole thing is really about is unwinding to a great extent the Basel III capital accords in the US. And I would argue that the entire Trump administration assault on the Fed, if you want to call it that, is about bank regulation. It's not about interest rates. I would argue ignore his statements on interest rates. That was all a red herring. It's really all about bank regulation, and they want to deregulate the banks. And if you think about, what you really want to get the economy going, it's not just lower interest rates. You want a mechanism for that to hit the economy. You want the
yeah,
banks to be lending to people.
yeah,
That is way bigger than interest rates. So
yeah.
I think this goes right to your thesis, Eric.
No, and that's why I'm kind of like, as we're thinking in the context of this bull market, that's why I thought maybe we're still like there's more innings to come of this that we haven't. I mean, we haven't seen really like heyday lending. It's just I've just noticed it's come up off of the it's above now the level it used to be. I can see the ingredients for why it could go further, and I just think Warsh is another just data point in there, and that we may. I mean, we may get back to where loans are growing at 15% or something in some bull market. I mean, I'm imagining, this is just me imagining, but that's what I'm trying to think what are the other could be the other chapters to this movie we may get where banks actually lend a lot more. So I think we'll just go on to the big one is monetary policy. And as you say, as we it's very difficult, but as we know, things a lot have changed in the last 6, 7 months. We had, originally it was Trump pounding Powell that he needed to lower rates more, and he needed a new guy in who was going to be more dovish. Um, that subsequently we've had the Iran war and we've had an oil price shock, so we haven't heard much about lowering interest rates from Trump recently. So maybe that topic is changed a bit, but um, Kevin Warsh is coming in a little bit with the background that he's supposed to be relatively dovish. Again, this can change, right? But this is that's how that's been the journey so far. Um, there's a mix of things. I mean, the other thing is we've talked about AI and the solopreneur, but he's made comments about how he expects AI to be relatively deflationary and that he's cautious about, he's trying to take that longer term view, kind of make nice gradual moves that are in line with what the effects AI may have on the economy and inflation, which he thinks might be like the internet, and so it could be low. Is that right? What he's you followed
Yes,
his work.
he's so look, despite the fact that I would characterize him over the course of not only his previous Fed tenureship, but also the last 15 years as generally on the hawkish side. There are some, and we should probably touch on this if you'd like to, these critiques of, oh, well, he's hawkish when there's Democrats in power, but he's dovish when
Oh,
Republicans are,
mhm.
in power. And there's this, famous chart in The Economist where they show that uh, Paul Krugman, in his usual way of completely, distorting the data, has an even more damning chart of it until you look at he actually took out several years
Oh,
from the calendar to make his chart fit. um but classic Paul Krugman trick. But that actually, it's completely ridiculous. If you line up GDP growth with it, that fits his language far better than any of
mhm.
the administration. So he's been a hawk all along, but then all of a sudden, lo and behold, last year when everybody's thinking about or he's in line to be Fed chairman, all of a sudden he comes out with this argument. And he's not the
Mm.
only one. There's other Trump appointee, Stephen Moran, uh, has made the same argument that, hey, actually, what we saw in the 1990s was that, we had a big productivity boom created by the internet and network computing. And as a result, prices were actually much softer. And so the Fed could have lower interest rates than what they were planning before. And that is kind of true, but it's also an incredible misnomer in different dimensions. It also is very different from the current situation, I would subscribe. So, yes, there's an argument for that. I think it's wrong, and I can go into why. But the key point is that the new chairman has articulated this argument and said, hey, I believe this. I think we can have lower interest rates. And so the question has been, is this him just angling for the job, and
How
or does
much
he
does he really
really
think
believe
this?
this?
Yeah.
And, I think the other critical question there is the one thing that he has said consistently throughout, even during this period, is he's talked about the primary thing that he complains about the Fed is a lack of what he calls epistemic uh, humility. So they have an epistemology, a framework, a way of looking at the world, and they think that they are absolutely correct in that, and thus don't respond as much to things in the data. So he would blame the inflation that we got through COVID, the reacceleration inflation recently, as being driven by the Fed being too focused on its models and not having the humility to see when those models are being wrong. So you think about those two things. If I'm telling you, I alluded, I very much disagree with this view that productivity is going to allow them to lower interest rates. Exact opposite in my view. Is
Yours is the exact
he
opposite?
absolutely,
Oh, wait,
absolutely?
tell
It's
us.
going.
What is that? Yeah. So,
Well, first let's just say,
okay, okay,
like,
okay, okay.
let's suppose I'm right,
Okay.
but he's come in with this epistemology that it should be lower, the way
So even
you
if he's
just
wrong, he
expressed.
should be able to pivot, right?
His humility, if he really believes in the humility, he should be willing to pivot. So I think that's going to be the big question we're going to see in the first couple of meetings. That is the
Was
critical
the
issue we
AI
need to focus
view
on.
just kind of job talk? And is the real thing, is the guy actually just super flexible and he's not an economist and he's maybe a more trade, like, almost like a
Yeah.
trader. He's like able to be flexible. Um,
Or even if he really believed it, confronted with the fact that inflation is double. And I'm not even talking about headline inflation with oil prices. I'm talking about core inflation, and you can even look at core inflation in February before the Iran war started, was running at more than double the Fed's target and accelerating. I'm sorry, you cannot be cutting interest rates in this environment, or you clearly are not showing that humility that he's suggesting.
yes. And this is the really difficult thing, I think, for him coming into this is really the Fed hasn't been below inflation hasn't been below the target since like March 2021. And they would look back and go, wow, this has been a series of really unpredictable things of how who would have expected COVID and supply chains would be completely disrupted. And then there'd be
Was it
Ukraine
like
war.
Lemony Snicket's series of unfortunate events?
Yeah, you said this is like just life, and I agree. And now they hit with another one. And so you're like, the tail of the tape is you haven't been below two since almost, 5 years now. And that's, so your new Fed governor coming in, one to be like, "Hey, guys, you haven't done a great job here." There's been a lot of public dissent, complaint about inflation and people in Michigan, consumer sentiment about this. It's an issue. Maybe you're supposed to jump on the brakes here. Um, just saying, that's one of your mandates. And then you get these complicating factors. I think one is the AI thing, but I think behind that also just reading the speeches a little bit. Well, first of all, is there a one-off? Is there I mean, the Iran war is very hard. What if oil drops tomorrow and we just hike the rates 50 basis points and now we're backing them off and they're trying not to there's just, yes, it is these shocks are difficult. The second thing is what I pick up from the speeches is they worry a lot about unemployment. And I wonder if so far, but we're here today and the employment rate is, and this is, I think, your view, employment's actually been quite strong. But they're very sensitive that yes, we're totally offsides on inflation, but everyone hearing about the white collar workers going to lose their jobs because of AI. We don't want to pour salt on the wound that we're raising rates as Oracle and everybody's blasting tens of thousands of white collar jobs at the same time. So, um, but we get to the point is the inflation rate isn't anywhere near where it's supposed to be.
No.
And now he's in this spot, and as I think someone else said, talk is cheap. It's easy to talk, and when you're, now he's in the hot seat. and it's a very difficult decision. And so that's why I think it's kind of an interesting thing for markets here, because if he's like AI, and I don't want to overreact, I don't want to overreact to shocks, and I don't want to AI is going to cause these job losses, and it's generally deflationary, and so I'm just going to kind of let this go. I mean, we could have banks lending, corporates spending their brains out, Fed talking about AI deflation sometime in the future. This could be a freaking blow off. It could be more gas on the fire.
Yeah.
Um, or we've run a lot and we've had this nice tailwind since 2024 of the Fed predicting 2% inflation, even though it's not happening, and them cutting rates by 150 basis points when probably they shouldn't have technically been doing that. They're a little bit driving ahead of the car, saying they were going to get there when they hadn't even gotten there yet. And we got rate cuts,
Yeah.
and we're living off of that. And I'm worried that if Warsh could shock the market if he were to say, gets his feet under the desk and goes, I need to kind of get things back on sides here.
Well, I think it is going to be a shock to markets. Do I think that that's going to derail the economy in any sense? Absolutely not.
Right.
I mean, look, we've had this war breakout. We've had a rise in gasoline prices. We've had this shock to consumers. We've had all this happen. We had 2022 where the Fed actually they were on the path to correcting their mistake, and
Yeah.
then they sort of snatched defeat from the jaws of victory over the last 18 months. Um, they raised rates 500 basis points
Yeah.
and in a little more than a year. And, we had a huge correction in bond markets. We had a huge correction in equity markets. We have not had a recession. We have not had unemployment go above 4.3%, which for most of my life was considered,
A great
structural
number.
unemployment, right?
Yeah.
And yeah, somehow now this is, oh my gosh, we're at 4.3. It's terrible. No, it's normal. That is
Yeah.
normal. So I think this is, and this really does get to that 1990s episode. So I can talk about why there are some differences then versus now, and why that doesn't necessarily apply. But even if we talk about then, real interest rates throughout that period averaged nearly 4%.
Mhm.
Okay. That's almost four times what 10-year real yields are giving you right now, right? Or, three times effectively. Okay. So, we are nowhere near tight policy. And yes, um, there were voices that suggested that given the tightness of the labor market, the Fed should have been hiking more back then, and there were these special factors holding back inflation, and the Greenspan Fed decided not to. But they still had rates over 5%.
Yeah.
Nominal front end rates over 5%.
Are you talking
They
about late 90s, like 90,
Yeah,
99? Yeah.
in
Yeah.
the late 90s.
We
So
still had
the
the big, yeah.
idea, and the critical point here is that, you're always, when you're doing policy, you are always weighing the cost and benefits and trying to avoid big mistakes. You don't want to make a big mistake on inflation. You don't want to make a big mistake on growth and employment, right? You have both of these mandates. Now, there's a really, really important underlying point here, that in reality, you have one mandate, which is inflation. Because if you screw up inflation, guess what? You're going to have a recession anyway. So you'd better get the inflation right.
Oh, is that
Okay.
really what they think in the Fed? Because I was worried their
That is
actual
what they
mandate was,
used to think. This is a
yeah.
really, really important thing. This was one of the big lessons of the 1970s and 80s, was that, hey, all you're doing if you err on the side of protecting employment is creating inflation
Which ruins
and
employment. Yeah.
ultimately limiting your um, scope to be able to address employment later because each time you do this, inflation just gets higher and higher and higher. And that's the problem. So you're much better off if you really want to protect employment, making sure you hit your inflation mandate. Okay. Now, the key point here is that even if the Greenspan Fed had erred on the side of saying, you know what, we're not going, we're going to worry more about inflation, the strength of that capex boom during that time was going to carry them through this. They would have had to hike rates a lot to really cut that off. And I would argue you're in the same position right now. That was my point about how we're going through this war. We've seen oil prices rise, we've seen gasoline prices rise, we've seen all of these hits to the economy, and yet nothing is stopping this massive capex boom. If you're doing that risk reward analysis, and inflation, to your point, has already been above your target for over 5 years now,
Mm,
you've missed your mandate for 5 straight years. It's double your target and accelerating. I, what does that balancing act look like? You have to err on the side of tightening more. You have to. You have no
yeah.
choice.
Yes. And the Fed had just cut 150 basis points from 2024. So it's not
Total
a
mistake.
big thing to do 75 basis points and get a
Yes.
little bit back on side and start actually doing something, which is kind of what feels like he probably would be a sensible thing to do, right? Um,
Look, we're going to see in the first couple of meetings
yeah.
whether that whole epistemic humility actually exists. And I saw somebody pointing out in the chat messages here about words are cheap when you're not in the hot seat. When you're in the hot seat, it's different, and that's valid. But I really don't see it. If you put me in that seat, and again, maybe it's easy, cheap talk for me out here, but I'm a relatively young, good-looking guy who's super rich, who has lots of
Yeah.
powerful friends throughout the planet, like Kevin Warsh. All I care about is my long-run reputation at
I don't
that
be the
point. That's
moron
the
that totally got
only
it wrong, right?
thing. Yeah, I don't exactly. So you are going to say, I don't want to go down in history as Arthur Burns, right?
Yes, that's their
And
worst nightmare. Arthur Burns, right? Is in the Fed. There's like a Arthur Burr. I don't want to be that guy,
yes,
right? Everyone's
exactly. And so I have no doubt that this guy is going to look at the fact the economy is absolutely ripping. There are
yeah.
no signs of weakness anywhere in this economy. And you tell me, oh, the Iran war could be solved in a week. Well, great. Then that means gas prices are going to fall even more and stimulate even more consumption. Like there is no downside, in my view, at this point, given
Yeah, it
that
bails me out a bit,
clearly,
right? If I raised rates and
absolutely,
maybe I should have, but the gas price dropped, no one's gonna yeah. Marvin, to your comments about the CapEx not I remember in 1999 being an investment committee meeting, and we were talking about the Fed had been raising rates,
yeah,
and there were some bulls in the room. It was our semiconductor analyst actually, just saying, "Look, it doesn't matter, like, whether it's 5% or 5 and a quarter, nothing is stopping there's, like, so much money flooding these companies, there's so much CapEx. This 25 basis points does not constrict the money supply coming into the tech center and coming
yeah,
into the economy in general." And that may be, what we look in hindsight. I'm being super bullish. And just to amuse your imagination, because we're all kind of it's very tentative to us every time the Fed raises rates. But what if we're in some cycle where we have we have corporate spending a lot of money. We have foreign FDI coming in, right? We have
yep,
Taiwan Semi putting in $165 billion of capex into the Phoenix area, building, I think it's 3 new fabs. Uh, the Korean Samsung, SK Hynix bringing in fabs. The whole reshoring and Donald Trump going around getting foreign capex coming in, domestic capex with the Mag 7 guys. I was at a conference talking about they cannot build stuff. The money is coming in faster. The bottlenecks are just on the ground. They're just
Yeah.
not sites. They're not turbines. They're not electricians to spend to deploy this money.
Yeah.
And then if you have the banks starting to lend again, another thing, if you look at the consumer lending has been quite moderate since the GFC. And if you look at the debt servicing ratio, it's quite low. The balance sheet of the consumer between their house price, their stock portfolio, you're starting to see a pickup in consumer lending. So the point could be that we might be really underestimating how powerful this economy is. And like a couple rate, what if we're sitting here in 2027 and Warsh is like, oh my God, how do I rein this thing in? Maybe this is like it got away from me a little bit, and we're kind of worried. We're sitting here. I'm worried about. Look, we've had a great run. How shocking would it be if we got 75 basis points of rate hikes? Could the market handle that, or is there just too much peak euphoria, and that's the pop of the bubble? But I think this is a good thing that I think Marvin, you're just starting with when a guy sitting in that seat doing the regret minimization analysis probably is going to do some moves here,
Yeah.
especially with, payroll
Especially
being
since that
okay.
seems to be his inclination, right? If we look at his, track record, that's where his sort of comfort zone is. And if people are under stress, they tend to go where their comfort zone is, right?
Yeah.
So look, your points about the investment boom. I mean, you're familiar with my research. I've been making this point that look, the capex boom we're going through started in 2012. It is not driven by AI. AI is
Mm,
additive to it. It this capex boom started in 2012. Go look at the data. Um, and it has just been expanding ever since. And if you go look at what happened in the wake of Liberation Day last year, a lot of people thought, oh, this is going to drive down foreign direct investment. This is going to um, uh, um, y- you know, impair companies' willingness to invest in the United States because, it's going to be so much more costly to do business here. Well, what drove this big investment boom since 2012 has been this, phenomenon I've been talking about for years now called localization. It's actually more efficient to build automated factories close to your consumers than it is to use outsourced supply chains, right?
mm,
And that's been being proved through new development in factories, new automation over the course of the last, what is it, 15 years. And with each one of these sort of trade shocks, whether it was Donald Trump 1, whether it was COVID, um, now Donald Trump 2, each one, all sorts of companies that were on the fence, as usually companies are, big investment decision is sort of a gray area. You're like, well, we might want to do this, but I don't know. How do we do this? Well, you get hit with, oh my gosh, we're going to have to pay all these tariffs. If you were on the fence, you all of a sudden go for it, let's bail in. And the reason why I say that is I actually tracked the investment numbers last year. And if you look at the investment announcements, it's not just all the ones that Donald Trump pressured people to do it. The US absolutely raked in global investment. It was $2 trillion in announced investment in the US economy. And over half of that was manufacturing. It was not all data centers. Over
mm.
half was manufacturing. Okay. And to exactly your point, what do we suffer from in the US economy? It's not a shortage of, oh my goodness, interest rates are too high for me to borrow. It's, I can't find a welder. I can't find an electrician. I can't find a pipe fitter. I can't find construction workers. I can't find anything. Oh, by the way, we've shut down immigration. This is such a massive,
Hot pot.
yeah, and then you're going to add bank deregulation to this? I mean, there is
And
no question.
can I add another one? Because and by
Yeah,
the way, I wanted to
please.
say to everybody, write your questions, and I'm just trying to keep track of them. But one thought I had was one of the bull things about last year was there were the tariffs, and then the interest rates didn't move, inflation didn't really change, and kind of went, whoa. Yeah, because everyone was like, yeah, so it was like, oh, it's kind of like a nothing burger, right? And so we roofed it. One of the things I just thinking, just from my emerging market experience, is that often when there's a shock, a currency shock, it's usually in the EM, it comes because the currency's devalued. And so for a lot of imported, there's everything imported that you used, so there's price inflation.
Yeah,
And what I've noticed with the EM and, mostly Africa, this is based on consumer stocks get killed right off the gate, right out of the bat. They usually have foreign inputs and they can't pass that on to the consumer right
yeah.
away. But generally, over the next 12 to 18 months, they do. And they kind of just slowly work it in, they get the margin back. And that's like a little trading investing game. But I kind of was just thinking with the tariffs, I'm like, was there a situation where it was quite well telegraphed that there were going to be tariffs? There's a lot of front loading, building up inventory, and so companies like Nike or TJ Maxx didn't have to shock people. I'm just wondering if there's latent inflation pressure coming down the pipe that, they're going as that low cost inventory winds down, and we see the full impact. And because you see in the price, in the manufacturing PMI, services PMI, they're all prices paid component is very high. And I just amongst I mean, you've written about the four drivers, the localization, all the things. I also wonder if that tariff thing that we were worried about, there was some mitigating things, some preparation, so we haven't been hit with that may be that will maybe creeping in behind the scenes, and then we have an energy on top. So just to say, I think it's safe to say we're gonna be in the 3 to 4% inflation range for a couple months at least. Um,
Oh, I think it's going to take longer than that. And I think, look, there's some questions in the
yeah,
chat
you can jump on those if you want. I mean,
that
I
are
should.
no, but they're getting to some of your questions. So let's talk about how I see inflation forming, right? Because it's not the way a lot of people do, and
Oh, I
so
love
I think
this. This is a new view? Okay.
well, it's actually not. I would argue it's a very traditional economics view. Just people forgot about it, which is, my research is called thematic markets. Why? Because I think themes drive things, right? There are these big underlying themes that ultimately drive the economic phenomenon we see. And one of my themes is called being is believing. And that's, if you were an
Oh,
economist, what that really is inflation expectations. Now it applies in other places as well in terms of debt and all sorts of things. You could actually apply this, but the key point is that beliefs can become self-fulfilling.
mhm.
Okay. And what has been the key driver of inflation? It's actually the rise in inflation expectations. This is what people don't seem to get, right? So we had falling inflation expectations throughout the last decade. That's why inflation kept falling, even though, all these people saying, oh, we're going to have all this inflation because the Fed is doing all this QE. No, because people's inflation expectations were falling. And so if you expect prices are falling and you're Coke or Pepsi and you get hit by a cost shock, you say, I could pass this on to my consumer, but if I know everybody thinks prices are falling, they're going to switch from me, Coke, to Pepsi because they think I'm trying to gouge them.
Yes.
And the long run value of that margin is not worth it. I'm just going to absorb the cost shock and I'm going to keep my
'Cause
margin
I
for the
might
future.
Coke might not raise prices, I do, they're just everyone's
Exactly. And so what happens is because inflation expectations are contained, guess what? Inflation is contained, even though you've had cost shocks. Now, what happens when the Fed, say in 2020, all of a sudden says, hey, guess what? We are going to purposely try to have more inflation than our target. we're going to try and throw it to the moon. We're going to create as much inflation as we can, which is literally what their policy changed to.
Yes,
And
exactly.
all of a sudden, you get hit by the cost shocks of COVID at the same time. Well, guess what? Everybody said, wow, I can't tell whether this is Coke trying to gouge me or all that inflation that I expected. So I'm just going to accept it and buy the Coke anyway. I'm not going to switch to Pepsi.
And
And
Marvin,
that's
can I
how
say,
inflation starts. And it just continues that way. So please go ahead.
yeah, just to say I was over in the US and because I feel it, I see it more in the US. I just you go around and you have dinners and you get like a salad and a glass of wine I mean, just the prices on everything. I was just like, yeah, whatever. Yeah, a salad. It's a rocket salad with some walnuts in it. It's $25. I was just I got to the point yeah, sure, why not? Why not make the salad 30 bucks? And I just was like, whatever. I was kinda like that. I was just like, "Okay, the game is on." Like, and maybe I should be raising we should just all raise our own prices and everything because everyone's screwing everyone at this point. And so, yeah, I was mentally kinda going to, "Geesh, yeah, like,
But
you're getting away with that
this
price?"
is exactly the thing, is that if your inflation expectations are stable or falling, then you get an oil price shock. So this is a really important point because you'll hear central bankers talk about how they should look through a supply shock. That's only true if inflation expectations are stable.
Yes.
Because if they're stable and people expect that, then you go to the gas pump and you say, oh my gosh, it's so much more expensive. That's a real hit to my income. The price of gas went up relative to my wage. I just got poor. I'm going to cut back on consumption. Whereas if you were expecting inflation and you say, oh, well, this is just all that inflation I was expecting, my wages are going to go up with it. You
Yeah.
go ahead and you buy the gas, you go buy the walnut salad, you go do all those things. And that's what creates the inflation. And the reason why I point this out is that remember I said earlier that the Fed had actually they snatched defeat from the jaws of victory. So they screwed up with their FATE program. They let inflation get out of control, but then to their credit, they went up, they hiked rates like banshees. They did what they were supposed to do, except they took it off too early.
Yeah.
And if you look for that first year or so afterwards, you went back to a moment where people did start to, when there was a surge in inflation, you could see it in the data. Retail sales, personal consumption expenditures went down. It was like this back and forth seesaw. What do you observe over the last 6 months? Retail sales, personal consumption expenditure positively correlated with inflation. They're going up together. And I'm talking about real expenditures, not
Mm.
nominal expenditures. Real expenditures are going up with inflation precisely because people's inflation expectations have gone back up. So when they get hit by this, they're like, oh, this is a nominal shock. This isn't a real shock. My income isn't really falling. I'm going to keep buying. That's what they have to tackle. And so I think that's really an important point to make here, because what that means is that if you are a central bank, you can no longer look through a supply shock, because that supply shock is going to be accepted as a nominal shock by consumers because you blew it and let inflation expectations
And if
get out
I'm
of
putting
control.
your, like, super smart economic talk into, like, moron like, just Joe Blow on the street like me, it's like, "Oh, well, this is just another one of those things." Like, yeah, there's just always something going on. It happens all the time, and every time it does, the price goes up. So this
Well,
is just like this is the new normal,
let me
right?
put it
So
in
my
real
I'm just like, "Yeah, right? Yeah,
let me put
see?"
it in real normal speak, and why people were so angry and still are so angry at the Fed is that we all have one of those friends out there who always says, no, 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 I do try, but it was this event, and then it was this event, and then it was this event. And at some point you say, maybe it's not the events, maybe it's you, because you're the one who keeps doing this. And to your earlier point, about the Fed. They've been telling us for 5 years now, oh, no, no, it's not me. It's this shock and that shock. And I can take you back through history and show you that every other Fed faced all sorts of shocks, including COVID-sized shocks. They did exist. People went through them. And you know what? Previous Feds dealt with them. This Fed hasn't. And at some point, you lose faith in that person. And people have lost faith in their central bank.
So I'm going to try and wrap up where I think, again, if anyone wants to get any last questions in, we've got Marvin Barth. The guy is insane. We've got him on the show. Just get your questions in. But if I'm wrapping up where I just my own market view on this, I'm kind of like, he's definitely going to be supportive, but he's keeps the bank trade is in motion, that he's supportive of that. It's another kind of data point in that banks waking up from their sleep and adding to this bull market. But also maybe that we've got a lot of quite strong inflationary trends cooking here, and with a lot of capex and growth, and probably, if you call it a shock, call it common sense. Warsh is probably going to start making some moves to raise rates. My take is that it won't be. It might be shocking if you say 25 to 75 basis points, but I don't think that is act. I think it might be shocking as a change from cutting, but I think maybe what the support or the on a, maybe the economy and this bull market. I'll say the economy rather than, but is much stronger than we think, and that is not going to derail what's going on now. And we may be actually underappreciating the amount of momentum going on.
I absolutely think, the economy is doing great, and we're going to continue to see extraordinarily strong growth coming forward. And they're probably going to have to hike a lot more than even the most
That
bearish people in bond markets anticipate, given that acceleration in inflation expectations. And so I think your game plan has to go back to what I think was the right game plan back in 2022 is we're going to get a big real interest rate shock, right? Which means that, the discount rate on your stocks is going to go up. So that's going to lower prices. But in the background, the economy is going to be doing fantastic. And as you said, the banks are going to do well. And so what you want to do is either interest rate hedge your equity portfolio, right? Or you want to do sector specific trades, be long banks, be long, industrials, especially mid cap industrials versus high duration stocks that are going to be more affected by rising real interest rates. So, just
Marvin, what do you think on the
hedge your
10-year?
portfolio.
Does the 10-year just go, oh, cool, the Fed's doing its thing, I'm just going to hang out here in the 4.5% range, or do we get like, hey, I've kind of wondered if we have a move here to six, like to some, the 10-year. They could take it both ways on this, right? That,
I
hey,
I
we're in a
I I
higher.
I don't look. Eventually,
You don't
it
have to make a
will.
call if you don't want.
It no no no. Eventually, it will help out the tenure. But I think we're going higher from here, right? Because the whole level of the curve has to shift up. And so you start raising the belly of the curve, it's going to push up the 10 year as well. That said, the term premium on the 10 might come down. I'm a little bit leery about saying that in this environment simply
Okay.
because, frankly, we have an uncertain Fed that I think has blown it, a new Fed chairman that a lot of people have questions about, reasonably so, given President Trump's rhetoric and that he appointed him, things like that. And we just have a global environment that is far more uncertain. So I don't think, I don't think there's value in long end term premia, but I can't say that if they actually did go and tackle inflation aggressively, that you wouldn't see some term premia compression there. That's still a higher 10-year yield given the rise in base rates.
I don't see him being aggressive. I just see him doing something which is not, which was maybe 3 months
Did
ago was not what the market even thought was going to happen.
did you see them hiking like they did in 2022?
No, no, no.
Yeah, well, I did, by the way.
Oh, Karis, well, that's
um, but look, I do. I stick by my original call that I think Kevin Warsh is a hawk and will show himself as such. But I have to say, I do have concerns about how, given his rhetoric that we talked about before, about him, viewing the 1990s episode incorrectly, in my view, that it will take him a while to get to that. And so I do think there's a risk around my views there.
Marvin, I'm gonna give one last one that's kind of I've seen a couple questions like, does this have is there a dollar view here at all on this? I think you're generally a strong dollar guy, right? Does any of this Fed being behind the curve, countries under pressure because they gotta, is there like a selling treasuries? Is there any kind of, is there any, I always interested if there's a big dollar weakness has so many asset allocation, effects
Yeah.
I see someone asking about whether the country selling treasuries could have an effect. I generally find that I always think it is I always find the treasury market seems to absorb all these things quite well, and that's not usually what Turkey selling treasuries doesn't seem to ever do anything, right?
Yeah, I mean, look, um, people forget about the fact that the biggest single source of wealth in the world, like, people want to talk about, oh, China used to own $1 trillion worth of treasuries. They don't anymore, by the way. And they could sell them. And I'm like, yeah. And you know how much US pension funds have? 100 trillion.
Mm,
The real money in the world is actually in the US. It's not outside.
yeah.
Now, that said, there are lot of big sources. There's, the Australians have a big pot of money, the European pension funds, the Dutch and the English in particular. I'm not saying that they can't have an effect. They can, but ultimately, what drives the dollar in my research and my background is in foreign exchange, I would argue that you would be hard pressed to find somebody who's got a better 25-year track record of calling the dollar than me, is ultimately it's driven by relative returns to capital. So if the US continues to have a advantage in terms of um, drawing capital in to its tech boom, which it is, right?
Mm, yeah.
Then the dollar is going to continue to perform well. The dollar is extremely expensive in historic terms, and hence it's hard for me to see the dollar appreciate a lot from here. But my call since 2020 or so has been we're just going to be in a long, high valuation range for the dollar, which is exactly what we've been. And
I
I
was
don't
just
see that changing yet.
I'm gonna let you go because but I was just to say I was at this conference, an AI and energy conference. It was basically the concept was that the technology sector now needs to really be speaking to the energy sector because they're hitting these bottlenecks about how do they power these data centers, and they're happy to speak to Permian gas companies and pipeline companies and GE Vernova turbine companies and interact with an industry that they normally didn't have to talk to, but it's turning out to be very important to the growth of AI. And I was just like, wow, the US is pumping. I mean, it was, on the LNG, on the energy, on the tech. I mean, the US coming out of this Iran war, US is turning into the gas station for the world. Very secure, Gulf of Mexico, LNG, so and then I was like, are we about to we could, we become a quite a, good energy exporter. I'm like, are we about to become a massive token exporter? I mean, there's this all these data centers, it's going to be a new export. It's going to be a new thing for your model is token exports or something. But I was just like, sheesh, this is, and also I was at this conference and all the tech guys were hanging out with the Houston oil guys and they went golfing together. and it was very collegial, old school business style. And I was trying to think. I mean, we're in London, Marvin, and I was trying to think where a French data center guy could hang out with. I didn't know where like all those different like the head of Microsoft, the head of AMD Semiconductors can hang out with Scott from GE Vernova and play around a golf together and go, yeah, we'll get you, I was like, this is a very powerful platform, the US, business wise. And, they're all, it really produces, it's right now, it's really coming together these assets around technology, these assets around energy in this new, AI data centers. I mean, I don't know where you could maybe do this in the Middle East where you could have this kind of ability to roll out large scale, but no one wants to put out a $50 billion data center where it might get hit by a missile. So we're seeing this. The US is really monopolizing a massive new wealth creation. Just to go back to the dollar, I'm like, this is really powerful. This is really unique in the world. This kind of scale of this new tech, everyone around the world, when you want every time you type a search thing, it's firing off. The software is thinking, and that thinking is probably happening in the US and it's generating a token, and that's new export. Anyways,
Yeah.
it's kind of like
No,
I hadn't been out of the US and I was back there for this thing. And I was like, oh wow, it's quite unique. The oil guys were super cool. They're all, I mean, and they all knew each other, which was kind of funny. Like that, like I don't know, the CEO of ENI in Italy doesn't hang out with the CEO of Total Energies in France, but the guys down in Houston all know each other. And hey, Scott, hey,
well,
Dave.
part of that's because, like, the U.S. energy industry has wholly consolidated in Houston. Like, Houston is everything now.
Yeah, I was just to see how they knew each other and just were hanging out and was on. It
Yeah.
was quite
It,
in that now the tech guys were trying to know them and
uh,
get into that kind of. Anyways, guys, it's Friday. Go back to your trading and making money, I hope. And thank you very much, Marvin, for coming here.
hey,
You
thank you for
delivered the
having me on.
goods. You nailed it. We were lots of great insights on Kevin Warsh and the markets. Thank you. Thanks, everyone.
Always a pleasure. Thank you.